Welcome to FXTech's comprehensive USD/JPY Analysis Report covering the critical week of October 27th through November 1st, 2025. This week saw major central bank decisions from both the Federal Reserve and the Bank of Japan, along with significant geopolitical developments that shaped the currency pair's trajectory. In this presentation, we'll break down the technical analysis from 5 major Forex sources, examine the key news events that moved the market, and provide you with actionable trading strategies for both the short and medium term. Whether you're a day trader or a swing trader, this analysis will equip you with the insights you need to navigate the USD/JPY market with confidence. Let's dive in. USD/JPY reached a significant milestone during this period, climbing to 154.415 yen, its highest level in 8 months. As of the market close on October 31st at 22:22 GMT, the pair was trading at 154.004, showing a modest daily decline of just 0.07%. But don't let that small daily move fool you. The bigger picture reveals impressive momentum. The pair gained 4.73% over the past month and 6.45% over 6 months. The day's trading range spanned from 153.647 to 154.415, with volume reaching 279,620 contracts. The key driver behind this rally? A widening interest rate differential between the United States and Japan. The breakout above the critical 153.26 resistance level has opened the door for further upside, confirming the bullish trend that multiple technical indicators are now supporting. 7 major events shaped USD/JPY's trajectory this week. First, the Bank of Japan kept rates at 0.5% on October 30th, weakening the yen despite Governor Ueda's hints about a possible December hike. The decision was split, with 2 members dissenting. Second, the Federal Reserve delivered its expected 25 basis point cut on October 29th, but Chair Powell's hawkish tone for December kept the dollar supported. Third, the Trump-Xi trade truce on October 30th boosted global risk sentiment, creating mixed signals for USD/JPY. Fourth, US CPI data came in 0.1% lower than expected on October 25th, reinforcing the Fed's rate cut path. Fifth, Japan's new Prime Minister Takaichi's dovish policies are expected to keep the yen weak. Sixth, Tokyo CPI data on November 1st showed heating inflation, causing USD/JPY to stall above 154. Finally, US-Japan talks and Treasury Secretary Bessent's hawkish comments on Japanese policy provided temporary yen strength. The net result, USD/JPY climbed to multi-month highs, driven primarily by the yield differential and the BOJ's continued dovish stance. All 5 major Forex sources we track: Investing Live, Action Forex, Forex.com, Daily Forex, and TradingView, confirm bullish momentum for USD/JPY. Investing Live identifies resistance at 153.27, with a bullish bias above 152.47, targeting 154.80. Action Forex sees support at 151.52 with an upside bias, targeting 156.05 and then 158.86. Forex.com points to support between 151.95 and 152.18, maintaining a bullish outlook toward the 8-month high. Daily Forex suggests a long-term bullish trend with entry above 153.08, targeting the 155 area. Even TradingView, which shows neutral indicators at current levels around 154, doesn't contradict the broader bullish consensus. The overwhelming agreement? Key support levels between 151.52 and 153.27 must hold for the trend to continue toward the 155 to 158 range. This kind of multi-source confirmation is rare and significant for traders looking for high-probability setups. Let's break down the critical price levels that will define USD/JPY's next moves. On the resistance side, we have three key targets: 155.00, identified by Daily Forex as a psychological level and upper trend line; 156.05, Action Forex's 100% projection target; and 158.86, the next major resistance according to Action Forex. On the support side, we have five crucial levels: 153.27, the previous resistance now turned support, according to both Investing Live and Forex.com; 152.47, the 100-hour moving average from Investing Live; 151.52, Action Forex's key support for the bullish outlook; 151.00, a pullback support level from Investing Live; and 149.38, the neckline for a potential double top formation identified by Forex.com. The 151.52 to 153.27 zone is the critical battleground. A hold above this range confirms the bullish trend, while a break below could trigger a deeper correction toward 149.38. Traders should watch these levels closely for entry and exit signals. For the next 1 to 2 weeks, here's your trading playbook. The primary strategy is a long position with entry on a dip to the 153.30 to 153.50 range. Your target is $155, with a stop loss at $152.80. This setup offers an attractive risk-reward ratio of 1 to 3.4, meaning you're risking $1 to potentially make $3.40. For those considering a contrarian approach, there's an alternative short strategy. If the price fails to break 155.00 and shows clear bearish reversal signals, you could enter short with a target of 153.00 and a stop loss at 155.50. This also offers a solid 1 to 3 risk-reward ratio. Key events to watch include U.S. jobless claims and PMI data. Any significant deviation from expectations could impact USD strength. Also, monitor speeches from Fed and BOJ officials closely, as any change in tone regarding future monetary policy will be critical. The trend remains bullish, so the primary strategy is to buy on dips rather than fight the momentum. Looking ahead 1 to 3 months, we have two scenarios to consider. The bullish scenario, which carries high probability, assumes the BOJ remains dovish, the Fed maintains its hawkish tilt, and risk sentiment stays stable. Under these conditions, the target range is 156.00 to 158.00. The strategy here is straightforward: buy on dips, targeting higher resistance levels, and focus on accumulating positions during pullbacks to key support zones. The bearish scenario, which carries low probability, would require a BOJ surprise rate hike, the Fed becoming more dovish, or a significant risk-off event. This would target the 151.00 to 149.00 range. The strategy would be to sell on a confirmed break below 151.50, but only after waiting for clear reversal signals. The key insight? The structural yield differential and central bank policy divergence strongly favor the bullish scenario. The bearish case requires a significant fundamental shift that isn't currently priced into the market. Position for upside while maintaining stop losses below key support levels. Every trade has risks, and USD/JPY is no exception. Let's examine both upside and downside threats. On the upside, 3 factors could accelerate gains. A more hawkish than expected Fed statement could push USD/JPY higher faster than anticipated. A significant delay in BOJ policy normalization would widen the yield differential further, and continued USD strength from safe haven flows due to global uncertainty could drive the pair beyond our resistance targets. On the downside, 3 risks could trigger a reversal. A surprise BOJ intervention to strengthen the yen could cause a sharp decline. A sharp deterioration in U.S. economic data forcing the Fed to accelerate rate cuts would weaken the dollar significantly, and an escalation in geopolitical tensions triggering risk-off sentiment could lead to yen safe haven buying. The primary risk to monitor? A surprise policy shift from the BOJ. Traders should remain vigilant for any signals of intervention or unexpected rate hikes, particularly given the two dissenting votes at the recent BOJ meeting and Governor Ueda's hints about a possible December move. Before we conclude, let's talk about the foundation of successful trading: discipline. Here are the first three essential principles. First, position sizing. Use appropriate position sizing and avoid over-leveraging. Never risk more than 2% of your capital on a single trade. This simple rule has saved countless traders from blowing up their accounts. Second, stop-loss orders. Always use stop-loss orders to manage risk effectively. Define your exit point before entering any position, not after the trade goes against you. Your stop-loss is your insurance policy. Don't trade without it. Third, stay informed. Monitor economic news and central bank announcements closely. Market conditions can shift rapidly based on new information, especially in Forex where central bank policy drives long-term trends. Set up alerts for key economic releases and Fed or BOJ speeches. These three principles alone will put you ahead of most retail traders. Now for the final two principles of trading discipline. Fourth, respect key levels. Honor the support and resistance zones we've identified in this analysis. These levels provide critical decision points for entries and exits. Don't try to be a hero by buying at resistance or selling at support. Wait for confirmation. The market doesn't care about your opinion. It only cares about supply and demand at these key levels. Fifth, adapt to market conditions. Be prepared to adjust your strategy if fundamentals change. Flexibility is key to long-term trading success. If the BOJ surprises with a rate hike or the Fed turns more dovish, don't stubbornly hold on to a losing position. The essential principle? Disciplined risk management is the foundation of successful Forex trading. The high volatility in USD JPY requires strict adherence to these trading rules to protect your capital and maximize long-term profitability. Remember, it's not about being right on every trade. It's about managing risk so that your winners outweigh your losers over time. Let's wrap up with 5 key takeaways from this analysis. First, the bullish trend is confirmed. Multiple technical and fundamental factors support continued upside momentum in USD JPY. Second, the yield differential drives price. The Fed's hawkish tilt versus the BOJ's dovishness is the primary driver of the current trend, and this dynamic isn't changing anytime soon. Third, watch the critical support zone. The 151.52 to 153.27 zone must hold for trend continuation. A break below signals a potential reversal. Fourth, our target range is 155.00 to 158.00 over the next 1 to 3 months, with potential extension to 161.94 in the longer term. And fifth, risk management is essential. Use stop losses and monitor central bank policy closely. High volatility requires disciplined trading. Important disclaimer: this analysis is based on data from October 27th to November 1st, 2025. Market conditions can change rapidly. This report is for informational purposes only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making trading decisions. Trade cautiously and implement proper risk management strategies. Thank you for watching, and good luck with your trading.